There we are. Good evening, everybody. My name is Daniel Young. I'm the owner and founder of Adaptive Perspective and the Adaptive Perspective social media platforms. And I am back to talk about our stock market investment strategy utilizing closed-end funds. So, the normal disclaimers. This is an unedited video. Who knows what you'll hear in the background as I film these in my house. And today you're going to hear more noise because we're still prepping the week. And I've got my own chores I got to do after I make this video. Um, I am not a financial advisor. I am a financial strategist, and I don't speak like the herd. I walk in limited company, and sometimes I walk alone. Uh, so the normal updates. So the book is a work in progress, making progress, just not finished with it. About probably about three-quarters of the way done, um, and then a fine tune, and then we go from there. Uh, yeah, made it. Honestly, it's getting close. And currently, I'm working on the closed-end fund chapter. So this week, I hope to make a shorter video. Um, it in think of how to say this. Normally, I would say I don't understand the dip, but I think I'm starting to better understand the herd because the herd is running scared. But at the same time, quite honestly, it's fine. Let them panic. But why are they panicking? And to us, to the rational, it doesn't make sense. But I think it's a threefold answer. I think I can finally explain this. First, it's the herd. They panic when they're told to panic. History tells us that government shutdowns don't impact the market in any meaningful or lasting way. Yet, the headlines tell people otherwise, and they react on cue. Second, we keep hearing people complain that society is getting dumber. And that's not just a cranky observation, it shows up in behavior. Fewer people study history or data, and they're told what to think and told how to respond. And while that's not us, you and I know better. It means the herd swings more violently now than in the past. And third, when a population moves more emotionally and less rationally, we're going to keep seeing these wild swings because exaggerated reactions are exacerbated by temporary noise. But that's also why we don't chase the shiny objects. The herd is told where to go toward the glitter. We're in this for the long haul, identifying durable trends, scooping up opportunities that others are too distracted to notice, and buying sustainable growing dividends, regardless of market mood, which, I mean, I'll admit the ups are enjoyable and the downs are uncomfortable, but we still get paid. We know the value is going to go up and down. And historically, it goes up, but we know it goes up and down. It swings, and the dividends come. We still get paid. Our focus is simple: own assets that grow income and value over time. And when we sell, because at some point we will. So when we sell, we want both gains and potential growth. And that means we don't buy everything. We scout, dig, and sift. And we use the current chaos to position for a future calm. We pick downtrodden funds, selling at a discount, not because we expect them to stay down, but because the herd will eventually swing back our way. When they do come back, we'll already be there, deciding whether to stay or quietly sail on to the next opportunity. And in today's market, nothing has changed. Today's strategy, nothing has changed except the prices. And thanks to the herd's panic, our targets are now cheaper. So use their fear and buy the dip. Targets are the same: bonds and bonds proxies, end to end energy like oil and natural gas, and then technology beyond the large caps. So how does that look on a spreadsheet? Well, instead of the normal sift and sort, I think I can do it a little differently this week because I can sort the entire list. And if you want, I'll scroll it. So if you want to pause the video and check it out and see what all is here, by all means. So here's the top part. It stops at NVXG. Here, I'll highlight that again. And then there's the bottom part. So you can pause the video and see. You can see the discounts. You can see the pricing. You can see the dividend yield. On my end of things, when everything is selling at a great price, we have to go based on targets. And we pretty much have to focus on the yield. Now, if depending on your budget of what you can invest and won't, what you can invest and don't have, I guess you could say, like if we had everything, and meaning if we had more to invest right now, if we had a bigger stockpile, however you want to say that, we would buy more than what I'm going to pick at the top. But I would prioritize the same bond funds that I enjoy. And USA is the outlier. So BRW is currently selling rights, and the rights price is actually 10 cents lower than this. So if the overall price continues to drop, uh, I'll buy the cheaper of the two, put it that way. I don't know when the rights offering ends. I need to check into that. Um, and if the government shutdown continues and the herd continues to panic, we see that fear and greed index really start to dip and prices really start to slide, then you can kind of play the waiting game and you're on the edge of a coin because you know the herd. You can sit in the middle, but that herd will tip that coin one way or the other. And it's not exactly like buying the absolute bottom of the market is not the key. The key is buying the dip, knowing that in the future it's going to scale back up and you'll still come off better on the other end because a couple cents here and there isn't that big of a deal. But between 721 and 731, I mean, yeah, I want the cheaper price. But if BRW continues to fall past 721, then I want the better price. But the waiting game can work for you and it can work against you. So we'll see how that goes. FSCO, I still think is a great place to be, especially because it's that BDC. And in the current market and in the coming market, knowing how President Trump and Vice President Vance are just pushing U.S. investment and U.S. infrastructure, having that middle grade BDC and bridge, like above banks but not massive, uh, is going to be a huge thing. USA, I think I like USA better on the short end of things. And I get the long term stuff. Like I've read several articles about USA and the sister fund ASJ in the last week. And I get what Michael Foster's saying in this. I really do. But if you look at the overall price chart, it does tend to bounce versus ADX just tends to continue to go up. ADX looks more like a great escalator, and USA looks like a roller coaster ride, to be honest. Not as bumpy as CIF, not as bumpy as CIF or ZTR for that matter, but it does go up and down. So I think if you're willing to ride the roller coaster, you can stay in it long term. On my end, USA and ASG might be more just time plays, and we'll see how that goes. My current thought is to sell it at 20% and then just push the investment forward, but we'll see how that strategy works. So we don't have a huge stockpile because we just bought the last batch maybe a week or two ago before the before the shutdown, before the dip. So be it. Um, if I bought more than those three, like if we had more money on hand, here's how I would do it. I would avoid CLOs. I like OXLC, but um, since they're reverse buyback, the price has dropped, and the CLO market at large has not done well. And I'm all for being where nobody else is. I am all for being on my own, but even I still need a little bit more consistency and a little more assurance. that things are not as they seem. Yes, it's a fantastic yield, and they did just cut the dividend, and it stayed the same. But price wise, let's see, at transfer it was around $20 a share, and now it's at 15. I would like to see a bottoming and a resurgence of price on my end before I bought more, especially because it's still at 15 bucks a share. When it was at 350 a share and still paying the same amazing dividend, it was a much easier buy. At $15 a share or $20 a share, that's a different matter. But the CLO market itself, still not quite where I want to be. So that would eliminate a lot of the top 10. Um, I would still go BRW, FCO, USA, but I would also buy where the market is headed. We're going to need it's phases. We need more supply, so we need more production of oil and natural gas. We need more cooling centers and more data centers, more management of the data, right? And that also means we need more pipelines from where product is to the new data centers and new cooling centers. So all of that utility need and infrastructure need, I think, is a great idea for companies that have the pipelines and who own utility companies on their own, as well as DNP, who is just a utility commodity on its own. And I get DNP is selling for a premium, but it's actually under its 52-week average. So even though it's on a premium, it's one of the exceptions to the triple asterisk rule in the sense of when it's below its average, it's actually on discount because it hardly ever goes on real discount. But if you could actually find it for a true pure discount where it's below zero, then it's a buy. But my caveat to that is all of these funds are above where we bought in because we bought these funds when they were super low. 60 cents isn't much difference on DNP. It is on the short end. It's not going to be on the long end. KYN, we just bought when it's a little higher. I like it a little bit better than NML, a little bit, but I still like the companies. I just wish they would change their dividends. And on those, DNP is the long-term hold on my end of things. DNP right now is the long-term hold. Megi, which is another utility fund, is a long-term hold, except Megi is currently it's currently set to liquidate. It's a term fund. I think it liquidates in 2034. Uh, I have to go back and look. I think it's 2034. But so DNP and Megi are more long-term holds in the sense of long-term, I don't plan on selling versus NML and KYN are more short-term holds in the sense of they're cyclical. But we don't seem to be anywhere near the cycle ending. So we're on the forefront of this new technology, golden dome, golden AI birth, I guess you could say. Like we're on the forefront of the very bottom part of the escalator. We don't seem to be anywhere near the middle or the top. So even though I say it's going to be a shorter term than say DNP, it's at the same time it might take years in order for that term or that cycle to end. So of what we have, I would focus on BRW and FCO. Maybe USA, maybe. What I dislike about USA is we're not going to see a dividend until January, and it doesn't go ex-dividend for another month. So I like it, but at the same time, I don't like it as much as, quite honestly, the monthly payer. Um, that being said, it's about 20 cents less than when we bought it. So, I mean, it is a good deal. And discount wise, it fits the metric. And it is a great short term hold. So it's there, but it's not as, how to say this? It makes top three, but at the same time, I still like the top two better. So if we end up having the funding, it's worth it. What we don't have the funding for, but if we did have the funding for, I would get NML, KYN, and DNP. So it's for sure a top three with maybe a top six. And instead of me sorting the list to get to those six, I'd much rather just tell you now instead of taking 20 minutes to really go through and review every single fund like normal. So, my top three for sure are those three. And if we had it, which we don't, but if we had it, I would pick up those three and all three are higher than our buy-in prices. And that's so it's a threefold hesitation. I really like the top two, and the top three is a good buy. All these three represent where the market is and where it's headed, as do honestly all six for that matter. I think BRW, FCO are in perfect position now. As for the long haul, USA, we're on that in push of money into the US. So blue chip and AI is just a great investment. NML, KYN, and DNP are we're going to have that if technology is really going to have it is really going to take off, and they're also going to be beyond. So like when we hit the midpoint of technology, we're still going to need even more energy to supply it. But at the same time, on the flip end, all three funds are selling for more than our current average. And quite honestly, we don't have the capital in order to buy them all. So on your end of things, you're going to have to prioritize things too. What's the best deal for you now? What do you already have in your portfolio? Where do you see the market going? How much money do you have on hand? How much can you buy? And just remember that the more you spread stuff around, the higher it is to grow, or the harder it is to grow what you spread around. Or maybe the harder it is to grow. So if you spread yourself too thin and try to buy everything, it's really hard to see that really grow like you want. So that's really all I have for the week. And that's a huge part of the list that I'm not sifting. So, biggest takeaway is buy the dip, use the herd panic. And I get from a logical, rational mind, it's hard to explain why they do that. But at the same time, even though it doesn't always make sense to us, you're not going to be able to explain everything. So take it for what it is, buy the dip. And yes, when the herd stumbles and when they panic and freak out, that's fine because it lets us chart the next horizon. So use that data, use their fear, and buy the dip. And that's all I got. So I hope y'all have a great week. Hope everything goes well on your end of things. There we go. Video pause, froze. Gave me a little heart scare for a minute. Um, but whatever you have for the week, I hope it goes well on your end of things. And on my end, I've got to figure out the BRW rights offering and the deadline and make some decisions. So I hope your week goes well, and I will take care of my end, and we'll see what happens between now and the next video. So have a great week, everybody. Talk to you later. Bye bye.